I want people to remember that Tattooed Chef had a multi-billion-dollar valuation at the highs. Okay, multi-billion-dollar valuation. Welcome back in YouTube. Today we're going to talk about Tattooed Chef. This is one I haven't covered in a long time. This is the one that actually blew up my channel, as I was pretty much a one-night stand with Tattooed Chef. I was in and I was out after I read their quarterly report months back. Basically bought in around $13 a share, shot up to $16 or $17. Got the heck out of there, as I just didn't like how the company was being ran. I had questions with certain stock-based compensation, I had questions with their vertical integration, and I had questions with their margin and the competitive advantages that they stated that they had. With that being said, I really believe that Tattooed Chef is in a make or break report here, as earnings are right around the corner for the company. And this is really going to be the true test for the company, as I think this is going to lose a lot of investors if it goes bad, but I think it's also going to cement them as a legitimate company if it goes well. With that being said, there are a lot of concerns that I have with this company, so let's just get into it and we'll get a price target by the end of this video. By the way, if you're new to the channel, consider subscribing and smash that thumbs up. First thing I want to do is just take a look at their free cash flow over the last couple years. So as we can see here, free cash flow is -$4 million, -$20 million, -$68 million, and in the trailing 12 month, they're pushing over -$100 million in free cash flow. Their cash position has went from $92 million down to $27.7 million, which means they probably do not have enough capital, and that there's probably going to be either some capital raise in the near future and or dilution taking place in the next quarterly report. So guys, I would just say pay attention to the dilution if you are invested in the company. As we can see here, they have added some shares to the market, nothing crazy, but as I stated, I think it's going to be something you're really going to watch on this next quarterly report, as they don't have a ton of cash on the balance sheet, and so therefore if they're burning capital at the rate that they're burning it, as we can see here, total net losses are exceeding $26 million, makes me concerned that they are probably going to need capital to make ends meet for this coming quarter and going into the near future. So a major concern I'm seeing here is going to be the gross profits, guys. Look at what the cost of goods sold is. It's $57 million. They did net revenue of $58 million, which leaves a 1.3% gross margin of $740,000. Historically, this is a horrible outlook for the company, as normally they're doing between 15 to 7% on gross margins. The other thing we need to take in consideration is the fact that there was an 8K filled over the last few weeks stating that the accounting was pretty much jacked up. And so what we have to take into consideration with all these numbers is that there's a $5 million decrease in revenue, a $5 million decrease in gross profits, and a $4 million decrease in operating expenses, and a $1 million increase in net losses. So now knowing that that 8K form is out there, now what my goal is to do is to get an idea of what their full year guidance is going to look like here when we update these numbers. So when we look at full year guidance, this is where we're going to start really making the adjustments in the model here. So they're expected to do 280 to 285 million. That was with what revenue expectation is, but with this 8K, we have a $5 million decrease in revenue just for that quarter. So what I'm going to do is I'm going to use 275 to err on some caution here. So when I do my projections, I'm going to take off $5 million from the 280 that they were projecting in the original quarterly report, bring that down to 275, as this is a decline in revenue. As we can see here, I have 283 as my jumping off point when I ran my analysis. So this needs to come down. So now I get it at 275 with 29% growth rate, which is still fairly high overall. You know, I'm not sure I really love that, but I mean, that's what the company is projecting here. The other thing we have to factor in is that they are burning capital here, and I got to put a negative amount of capital burn on here. As they're burning roughly through 50% of their capital has been burning. they're burning roughly 50% through their capital. They're burning well more than 50% of their capital, going from 92 million down to 27 million. But there was an acquisition, so I'm going to be pretty kind here and just say that they're burning roughly 50% of the capital that's available. So you have 27.7 in cash, 27,700,000 in cash. So as we can see, the cash position has come down drastically, and I just tend to believe that there's going to be some dilution or some sort of capital raise that needs to take place in order to regain some liquidity within their company. Now, the one I'm having a hard time with is they're saying their gross margins are going to be between 8 to 10%. I don't see how this is possible. Yeah, I just don't see how we get their gross profits to where they're projecting, especially when we factor in the 8K that they filed. Last quarter, they were at 16.5. This quarter, they're technically negative when we factor in that they lost $1 million off of gross profits. So, just to keep it simple math, we can say 0, which does put it right around 8%. So I would technically be leaning towards the 8% at the high end, as I don't think inflation's completely under control, and I still believe that they're dealing with many issues that they were dealing with last quarter. I don't think that much has changed, so therefore, I tend to believe we're going to be looking closer to this 5 to 6% gross profit margin. We're using profit margins of 5% because they said they're going to do between 8 to 10, but after this 8K, I just don't trust that they're going to reach those levels. They're sitting right around 6 on the year, and I think they're going to get another hit here. So I'm just being safe on my end and saying that they're going to do 5 next year. Then maybe they'll bump up margins to closer to 6 or 7, and then years 6 through 10, I believe they can possibly push that 8 to 10% margin that they are projecting this year. I think they're way off of what they're going to do. I mean, I could be kind and just say that they do get to double-digit margins in 10 years. Maybe they do. So we'll put 10% in there. Next thing I want to do, because this is not a blue chip stock, guys, with blue chip stocks that have been around for 80, 90 years, I'm completely fine using a 12% return. With a company that has done nothing but sell off, the earnings have been garbage, the management hasn't proven that they've been true to their word, you have to put a buffer in here. And so therefore, I'm going to bump this up to about 16% rate of return and build some sort of safety in here, especially when you're dealing with depressed numbers, because a 12% move in a $4 stock means it only has to move 12 cents in order to really mess up your analysis here. The next thing we have to figure out is what kind of multiple do we want to put on an EV to EBITDA for Tattooed Chef? The reason why I won't go off of Tattooed Chef's history of EV to EBITDA is the fact that we were in a very inflated market and those multiples made no sense. So how we go back and get a reasonable multiple is you look at stocks that don't have high beta and that weren't in this bubble, and you see what kind of valuation is on them, and then from there you can kind of get an idea of what kind of multiple you should be putting on a stock. One of its peers is considered to be Farmers Bros, which trades at an EV to EBITDA of roughly 9. Forward EV to EBITDA of roughly 9. The peers are about 11. And you look at a company like Tyson Chicken, who trades at a EV to EBITDA of roughly 4.3 and 5.3. So, guys, I have to say that, Tyson should be trading at a premium. It is not. It is, Tyson Foods is fairly depressed valuations here. So I'm comfortable using a 5 to 6 EV to EBITDA when it comes to Tattooed Chef. Margins are going to be much worse with Tattooed Chef. Okay. They don't pay a dividend. Tyson Foods has great margins. Okay. They are the best at what they do. I mean, it's not even in the same ballpark. So to even be putting the same kind of multiples on it is very dangerous. But just to kind of give a jumping off point, I'm going to use a 5 to 6 times multiple here. And we'll use a 6.5 multiple on EV to EBITDA. And so when we get that, when we price that in, we're getting a fair price target around $2.39 and a DCF calculation of roughly $3, which puts it in the park of between $2.75 to $3 for Tattooed Chef, with a possible fair market value of 2030 around $4 to $5. Obviously, it could do much better than this. It's really going to come down to this quarterly report. That's why, guys, I'm saying after the 8K came out and after we really take our bias out and take a look at what they're kind of doing here, it's a pretty dangerous stock at this point. It could go down another 50% on bad earnings. But then again, if they are showing vertical integration and they are growing margins the way that they said they were going to do years ago, then we're talking about a whole nother ball game here. If the growth rates are still high and they're growing their margins and they're doing everything that they're saying they're doing, then I think you can get behind possibly paying a premium for the company. And that's where you might get your $8 to $10 range. But right now, guys, the direction that they're heading, for me personally, I think it makes a lot of sense between $2.75 and $3. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.